Good morning. DST versus a 1031 exchange. Which strategy is right for you? Well, selling commercial property often creates a good problem to have, and that's a capital gain. The challenge is deciding how to reinvest those proceeds efficiently. And two of the most common tax deferral strategies are the traditional 1031 exchange and investing through a Delaware Statutory Trust, or DST. While both fall under Section 1031 of the tax code, they serve very different investor profiles, is the point. And understanding the trade offs between control, your risk, your timing, and cash flow is critical before making a decision. So let's look at first, what is a traditional 1031 exchange? Well, a 1031 exchange allows you to defer capital gains taxes by selling an investment property and reinvesting the proceeds into another like kind property. So some of the key rules that you'll get faced with here include these, but we must identify replacement properties within 45 days. We must close those properties, whatever combination, within 180 days. And you must reinvest equal or greater value as well as debt into the equation. You also have to use a qualified intermediary. So why do investors choose a 1031 exchange? Well, it gives you full ownership and decision-making control. And your ability to actively manage or reposition the assets is still there. And there's also potential for higher upside through value add strategies. But here are some of the challenges. So tighter timelines create pressure on you as an individual. It does require active management, and financing, leasing, and operations are all on you. And a traditional 1031 works best for a hands-on type investor who wants control and they're comfortable executing a business plan. So let's look at what is the Delaware Statutory Trust next. And a DST is a passive ownership structure where investors purchase fractional interest in institutional grade properties, often multifamily, industrial, or medical office, and that's all managed by a professional sponsor. And DSTs qualify as replacement properties in a 1031 exchange. And why investors would use a DST? Well, it's truly passive income, and that's the upside sell for most folks. But there's also no management responsibility. And there's also institutional grade assets, which are otherwise difficult to access on your own. And you can close quickly, which is ideal for tight 1031 deadlines if properties didn't work out. So some limitations to understand are that you're not going to have control over operations or any sale timing. And your money is illiquid during the hold period. But your returns are steady, but they're also capped. So DSTs are especially popular with investors who are exiting active management, looking to just relax, downsizing portfolios, or just planning for retirement. So let's look at a DST versus 1031, a side-by-side comparison. And many experienced investors really don't choose either or, they choose both. So a common strategy is to allocate part of the proceeds into a DST to stabilize income and reduce your risk, and then use the remaining capital for a traditional 1031 into a higher growth asset. And this approach balances cash flow certainty with upside potential while still allowing you to defer the tax bill on the capital gain. So here's the final takeaway for the day. And really, the real question isn't DST versus 1031. It's what role this capital plays in your life and your portfolio. So if you want control and growth, traditional 1031 is the way to go. But if you want income and simplicity, then a DST is a better path. And if you want a balance, use both. So the right answer is really going to depend on you and your timing, your risk tolerance, your management appetite, and your long-term goals. And that, my friends, is it for the day. Love to chat more. My website is houstonrealestatebrokerage.com. You can figure out how to get a hold of me, and love to talk to you soon.